Good morning. Tuesday, August 25th. If you listened to me yesterday, we talked about having a bit more of a float bias. You're happy. Bonds better by about 2-3 basis points. Tens at 466. They're actually a little bit better earlier on. I think we touched 465. Pretty much up 2 to 6, 7 ticks across the board. We are creeping back towards sort of lock territory, regardless of situation. I mean, don't get me wrong, we're not there and it's not full on lock. We'll talk about that more in a minute. Overnight, not a ton of data. What we did get, arguably slightly bond unfriendly, albeit, once again mixed, getting maybe a little bit more complicated. We'd gone through that period where the global data was definitely worsening. I would say less so recently. Asian stocks up pretty much across the board, not exactly. Europe up across the board, certainly indicating better here onshore, 0.5 point to a point. VIX down slightly, Bitcoin down a bit. That connection, inverse connection, still working. What are we celebrating? Who knows? Truth 6,753 perhaps. Commodities almost worse across the board, but as you might imagine, certainly oil. Brent at 87 and change. I want to say we were at points 95 yesterday, certainly over 90. Either way, we're down about 3-4% on the day on oil. Crude, quasi testing an 80 handle, not exactly, but we are at 81.98. So really across the board, bond friendly data. ADP, if there's something to take the edge off a little bit, our 815 ADP came in at 11 and 3/4. So we had been trending for several weeks, single digit handles. So if anything, that's a little bit hot. No 8:30 data. We've got a bunch of housing data at 9 and 10 o'clock. Going to be interesting, hearing more and more about the state of housing. I don't know that I buy it. Tomorrow, GDP and the start of Jackson Hole, claims Thursday, sentiment, blah, blah, blah. We talked about this a bunch of times. Talk about next week here for a second. We hadn't touched on that, I don't think, yesterday. Monday's an off day, not literally, but data-wise. Tuesday, we've got JOLTS and ISM manufacturing. Wednesday, of course, ADP, among some other things here, by the way. Thursday, we got Challenger layoffs, ISM manufacturing, of course, claims, and then Friday, non-farm. So these next 9 business days, pretty significant. If I had to guess, that following Wednesday could be delayed because of Labor Day, but that Wednesday is probably CPI. That might be a little bit early for it. CPI usually hits around the 10th. But, for the most part, you're going to have almost everything that you need to know about September by next Friday. Both ISMs, PCE, the employment situation. So how do we handle today? To me, more of the same of the last few days, right? Is considering that, in theory, you're locked up for August. And if you're not, today's really the day to do it. I don't know why you wouldn't today. Here, you kind of play it day by day. You've got another day of free look. And as we talked about, being slightly more float bias, I don't know why you wouldn't be. Let's see exactly what the talk is in Iran. Iran, obviously we added some sanctions or whatever economic D-Day we talked about yesterday. Iran says it's ready for it. 3 hours ago, we were said to be sending diplomats to the Middle East. I guess that's positive. Um this is an interesting take. We're saying that the U.S.'s economic sanctions are a tacit admission of military failure. Unless we declare all-out war on Iran, I don't know that there's been any military failure. It is somewhat reminiscent, I guess, of Vietnam. Were we half in, half out? And is that why that dragged on? Or are we half in, half out here? Not a political show, so I mean, I don't know. I don't pay too much attention to that beyond the economic implications. But long story short, believe it, don't believe it. I don't really see anything different. I keep saying, one would think that we're closer to the end than the beginning. To whatever extent you happen to be happy about it today, God bless you. I'm no more or less encouraged by the progress in Iran, and I am no more or less convinced that what's going on there has any real long-term impact on the price of oil and gas, and therefore on the price of things. 5-coupon, we're not even at, to put some stuff into context, we're not even at 5-day best levels. We're 25 basis points behind 819 for the record. 5.5 on a 1 month, we're maybe mid-board, and that's a 3-month chart. So, let's not celebrate too quick. I think we've got a lot to recover, and as I talked about, September is as good enough a time to recover. We're at 2-day highs on 5.5s. We're closer on a 5-day chart. We're only maybe 5 ticks behind best levels. 1 month chart, we're still banging around the bottom. So where I think it gets perhaps a bit more interesting, is maybe 6s and 6.5s. That's where we're perhaps a bit closer to lock. Less. But really, across the board, these levels aren't fantastic. And given the trend and the news and the data, I would sort of continue my float bias here. But with every tick you pick up on the float, to me, that's a tick closer to being conservative. And I've talked about this before. If you took on, and let's talk about 6-coupon, which is sort of, production coupon. If you took on a floater, and really, truth be told, what you're really absorbing here is the roll. If you took on a floater, say, last Thursday or Friday on a 6-coupon loan, maybe you're an eighth better in rate, maybe, and I'm not sure you're even there. That might be a good story to tell, especially on a refi that you're trying to close in 10 or 15 days. I think, 6.5 coupon, 6.75 note rate, again, maybe. What I would look at is 5.5 coupon. If you took on a floater at the end of July, and now what you have the opportunity to do is you're 9 ticks better plus the roll. You might be a half a point, which could be not quite 25 basis points in rate better. That's one of those where I think you have a good story to tell, right? Maybe you go from a 30-day lock to a 15-day lock, or a 60-day lock to a 30-day lock, depending on the scenario. You pick up a little bit there. To me, if you've taken on a floater and now you're 25 basis points in rate better, and that's an if, I don't know about your exact scenarios, that's one where I'm maybe a little bit more lock bias. I think, that's a good story. It's you could take a victory lap. Hey, I suggested a float. your rate's a quarter a point better, or your fees are 75 basis points less in fee. Our average loan amount, call it $2,000. I saved you $2,000. That's one where I'm maybe a little bit closer to lock. I certainly keep an eye on it. As an originator, you have a little bit of a free look. For my cap markets folks, we covered a little bit this morning, despite my float bias. One, because bulls and bears, and it is a steer, not a bull, but maybe it is a bull. I don't know. Bulls and bears, but also too, I'm not convinced, in the absence of any real tier one data, and just to, other than PCE on Thursday, I don't know that we have any tier one data between now and that first ISM drop. What I'm looking to do is potentially trade a little bit of volatility. I'd find it really hard to believe, unless there is a full-on signing of a declaration of peace. It's hard for me to believe that we're going to rally every single day into this data. Maybe, and I can't rule that out. I'm going to say 20% chance. Why would we rally into the data is, well, if you look at a chart and if you look at where we sit, 97.11 on fives, and we were at or around a par handle here in the last 3 months, do you really want to be, that short, if that's where you are, going into a data cycle that is reasonably likely to disappoint? So, and I've talked about this before. In our industry, we look at a hedge as the prudent thing. What I might argue, and these hedges are a touchy subject nowadays. But at the end of the day, there are times where being long, right, is more prudent than being short. And I've been clear about this too. My bias is to being short because, ultimately when rates go up, it tends to mean less business. And if you're making less money on less business, that's a disaster, a recipe for disaster. So if you're a little bit short and rates go down, yeah, you might make a little less money, but you're going to do more business to offset it. But at the end of the day, I certainly am willing to accept the argument that it might be prudent to be a bit more long bias here. And so us covering this morning for our cap markets folks, to me, is more about anticipating a little bit of volatility and positioning around it than it is saying, hey, we did well with this float bias and now we're going to sort of full on cover. Yesterday was probably our worst lock day in a week, so I'm going to say that you guys were listening to the float bias. I never know if that's an exact translation, but I found that to be interesting. And yeah, so there you have it. I'd keep an eye on today. I don't know that the 10 o'clock data really matters. What I would say, and the 9, because we've got Case-Shiller and FHFA at 9. And then we've got some confidence and home sales, new home sales at 10. We've got some Fed speak this afternoon. Listen, if we get to a point, and the last set of housing data, I think, caught some attention. If these numbers are kind of bad enough to give you a window into the consumer, so to speak, they could be meaningful from a bond standpoint. But long story short, I think that you've got another day of free look. If I purely look at, call it 6 coupon, a 1 day chart, most desks probably priced maybe 2 or 3 ticks behind where you are right now. So I would expect, you know, if all things are equal in the next hour, I would expect you to maybe be an eighth in fee better on today's rate sheets. I'd say anything that you get better than that. If for some reason you were a half better in fee, that's where I think maybe my lock bias strengthens a bit, because now I'm looking at value. Your rate sheet should almost be identical to yesterday across most coupons. Um, 5 coupon, which I don't know that anybody's really producing into. That's where I think that you're a quarter better. 6 coupon, you're about 3 ticks better. 5.5 coupon, you might be 5, 6 ticks better. So I think anything better than that, if you're talking 6 1/8 note rate is somehow magically 50, 75 basis points better in fee, I probably pick that off and I lock that, because you shouldn't be. Maybe there's some par rate contemplation, end of month appetite, who knows. I always say if somebody's gonna, willing to give you money, kind of take it. But I think lower rates should only be 25 better max. Higher rates are like an eighth better max, and anything better than that, that might put me off my float bias, just because you're maybe getting a little bit better value than you should be getting. So that's how I see it. Thanks for joining live, watching on replay. I will see you guys tomorrow, 8:30. Some good 8:30 data. The highlight of the week for me with that PCE number. So other than maybe Warsh at Jackson Hole on Friday. So remember, Bulls and Bears make money, pigs get slaughtered. Thanks. See you tomorrow.